going to start in any case. My headphones on. All right, ladies and gentlemen, welcome to this week's Thrive in China Roundtable. I'm having a couple of difficulties with the PPT presentation, but when I look at what you're seeing, you're still seeing the screen. You're going to see a couple of the other slides later on in any case. Can't do any, I'm not a technical know-how in terms of the display and whatnot, but for some reason it's not using the old formatting system. But I still think you can see what's on the slide. If you are having trouble seeing things, do let me know. Just type it in the chat box, and that will help. So welcome to today's roundtable. It is the weekly Thrive in China roundtable. It is always nice for me, especially for those that are new to this, to tell me who you are a little bit. Give me a bit of an understanding on your background with China. Are you a newbie? Are you a startup? Are you an experienced China hand? This always gives me a little bit of insight in terms of who you are, and guides me a little bit in future presentations. For those of you that are here live, or for those of you that are watching this on replay, allow me to introduce myself. My name is Christina Kohler-Coluccia. I'm the head of business advisory at Woodburn Accountants and Advisors. I need to update this slide. I am now officially 20 years with experience in corporate services and compliance in China. I'm one of the leading experts on inbound investment to China. What this means is that 100% of my clientele are actually foreign investors that are looking to establish their subsidiaries in the Chinese and Hong Kong market. I've worked with over 600 companies at different stages of their China journey, all the way from market entry to implementation, and then ultimately to growth and scaling up. The beauty of China over the last 20 years has been the fact that a lot of administrative processes have become more transparent. And as a consequence, I've been able to create standard operating procedures, if you will, to help foreign investors get their foundation ready for their own Chinese entity in the Chinese market. So there are administrative processes like the China roadmaps, trademark registrations, incorporation, how to grow your business with your Chinese accountant, etc. They're all up on our website. You can download them free of charge and watch the recordings in your own time. And last but not least, for those of you that may not have received, apologies, guys, the presentation is working very slow. Could be because there's quite a few slides. If you guys have not received our ebook, which is the 10 biggest mistakes companies make in China, then let me know. You can email me at christina@woodburnglobal.com, and I would be happy to give you a complimentary free copy. So to start off today's presentation, we are going to be looking at profit repatriation strategies in China. Now, a lot of this has not changed from previous presentations I've done. The concepts are all the same. However, I am going to tell you slight changes in issues with banks and tax bureaus, okay, that we have seen actually since January 1st, 2023. So the first part of this presentation is outbound payments from China. I was trying to attract people to come in and listen to this presentation where they are contracting with entities in China, they're invoicing entities in China, but they are very frustrated because they are not receiving their capital, their money from these Chinese customers in a timely fashion. I wanted to explain to you in today's presentation by talking about profit repatriation, what it takes for a Chinese company to pay invoices, whatever it might be, abroad, okay? It is not a simple transfer. There is an administrative process that has to occur anytime you are making an outbound payment from China, from a Chinese entity to an overseas entity. And I hope I'm killing two birds with one stone by one, helping those that do have entities in China and who are looking to develop profit repatriation strategies, and two, help those that don't have an entity in China but are contracting with Chinese customers to have an understanding of what it actually takes to be able to repatriate or send funds from China abroad. So for those of you that have an entity in China or are planning to have an entity in China, I think the biggest question that you might have is, can we take our money out of China? This is all moving very slowly, so I am going to try and put it into the slide format, and I hope this works now. So the point of today's presentation is, or the biggest question that people have is, can we take our money out of China? Can we take our profits out of China? For those that don't have entities in China, your question might be, can Chinese companies pay invoices that are being issued to them and send that money abroad, right? So let's take a look at this. What are the most common concerns for profit repatriation in China? Now, the biggest concern that people have is in relation to foreign exchange risk and ultimately the lack of Forex in China. If many of you are not aware, the reason why it takes a long time for a Chinese company to repatriate funds abroad is because they have to do an application to basically get US dollar, get pounds, get Hong Kong dollar, whatever Forex amount. They have to apply to get it. And there is a lack, generally speaking, a lack of Forex in China, which means you will have to go into a waiting line to be able to get that. Okay, especially if those invoice values are quite high. Then, of course, there's the foreign exchange risk. There is general political risk where people have a fear. What if China one day says we close everything and we cannot send money abroad and money gets stuck in China? Then other concerns around capital markets, and ultimately the tedious and very bureaucratic procedural complexities. Now, points 1 and 4 are critical to me on a day-to-day basis. Foreign exchange, lack of Forex, and procedural complexities. The other 2 points, point 2 and 3, on a day-to-day basis related to my own business, I'm not concerned. After 20 years of experience, I've been able to repatriate dividends. I've been able to pay invoices abroad, whether it's to my own shareholder or whether it is to third parties that I have to pay invoices for. I have been able to do all of this. The complexity for me on a day-to-day basis to make these types of payments is really points 1 and 2, which is foreign exchange risk, lack of Forex, and procedural complexities. There's no government officer who's going to say, you can't do this. What they're going to come to you is say, do you have all the right documents in place? Are the documents true and authentic? Can I have supporting documents to prove that these transactions are real? Etc. They're never going to say, no, you cannot do any transfer abroad. Okay. I think that would develop extreme chaos in the Chinese market if you weren't able to take money out of the country. All right. Now, profit repatriation strategies are generally thought about at the point of where profit is made, which could be years down the line. So throughout today's presentation, I am constantly going to be raising the question, have you done your tax planning for your Chinese entity? And do you know when you are going to be profitable? When is that? Is that going to be immediately in year 1, or is that going to be in year 5, year 6, year 7? Okay. There is no point to develop profit repatriation strategies if you do not know the timing in relation to when you're going to make profit and when you're going to start implementing and executing these strategies. Okay. Now, generally speaking, as accountants in China, what we try to do is encourage our clients, knowing what their business model is going to be in China, and if they plan on transacting and being profitable, is that within 6 months of having been incorporated and having settled the relationship with the tax bureau, we start implementing these profit repatriation strategies. The reasons why we want to do this is because, first of all, it helps you free up capital for other forms of investment that you may want to do in other jurisdictions. It predominantly calms your nerves knowing that your money is sitting outside of China. I think that's for a good 80% of most foreign investors. It aids in developing true and authentic agreements, also something I'm going to constantly say during today's presentation. Why do I say that? It's because fake agreements no longer will be passed or will be approved. In the past, we could always create very vague, very broad type service agreements in order to be able to repatriate funds. This is no longer the case. We really do need to create true, authentic agreements and contracts. But the positive of that is the fact that you can then create a tax optimized structure in China by knowing how you're going to be repatriating funds and the timing of that repatriation. The third aspect that I want people to realize is that nobody is forcing you to take your money out of China. I started off the presentation saying, can you take your money out of China? The answer is yes, you can. There are just complex bureaucratic procedures you have to go through. But nobody is forcing you to take your money out of China, which means that if you plan on making profit and then using that capital to then grow and scale, you can do that. You can keep the funds in China for further growth and further scaling up, if that is based on your business plan, right? And what your strategies are, generally speaking, for the Chinese market. So the idea of just simply having the discussion of profit repatriation strategies is to say, do we need money abroad? Do we feel better if the money is sitting abroad? Or should we actually keep the money in China in order to be able to scale up quicker if that's needed? Now, why is it important to understand how to repatriate funds overseas? The first is that it helps you to understand the actual bureaucratic processes that are involved to repatriate funds overseas. Everything is possible in China, but nothing is easy. Okay, I want you to keep saying that in your mind. And I will honestly say, since January of this year, things have actually gotten trickier. And I'll explain that during today's presentation in terms of day-to-day operations with this. If all of you are based overseas, I am hoping that today's presentation will give you better communication abilities with your Chinese counterparts, because our biggest frustration sitting in China is the frustrations that you have that we're not doing things faster, or we're not doing it at all, because perhaps you do not have the transparency of what is required step by step, okay? So I'm hoping today will just give you tremendous insight in the actual processes that are required to be taken by the Chinese company. The other reason I want people to listen to this presentation is that I want you to understand the tax component related to these types of repatriation strategies. If you are a company that's contracting with China solely and you don't have a Chinese entity there, I'm hoping today will give you insight in terms of what are the tax obligations. This is one area where Chinese companies can cheat you on by saying that they will have higher tax liabilities that should befall on your shoulders, making your net revenue lower, because that tax will come out of the service amount that you're invoicing for. So I want you to be aware of what the tax components are for different types of repatriation strategies or overseas transfers. And then last but not least, I hope it helps you get organized. The reason why I say that is because, and I can vouch for it, as of this year, documentation is critical. And what is written in that documentation is also critical. Okay, so get a head start, get proactive. These are standard operating procedures that can be created very early on within your operation. And the issue, obviously, is that a lot of people leave this to the end once they're starting to make profit, which generally speaking doesn't mean you're too late. It just means you're going to be rushing to get all of these documents in place. Now, the next question that I'm going to raise is, do you think that the Chinese tax authorities are familiar with profit repatriation strategies? As of April 2023, they are extremely familiar with all types of profit repatriation strategies, which is also why they are becoming more and more critical about the content in your agreements and trying to check whether these transactions are just a way for you to get money out of China, or if there's actual substance behind them that makes them real and authentic. And I will share my personal experiences with this because I'm going through troubles myself at Woodburn in terms of being able to repatriate funds abroad. Now, when you are creating profit repatriation strategies, I want to give you 4 tips. 1, true authentic agreements and contracts are required. And by true authentic, I mean the scope of service that is in these agreements must be true and authentic. Be smart. You cannot fool the tax authorities. And I should have mentioned this here. I also want to say the banks. The banks are becoming the obstacle currently in 2023. So you can't fool the tax authorities and you can't fool the banks. So don't mess with them. Don't try to fool them. It's just going to leave a bad taste in their mouths, and they might not then cooperate with you in the long term. You've also got to make sure that the company that is invoicing you in China, so the overseas entity, has economic and commercial substance. Okay? The reason why I say this is because you cannot benefit from the double taxation agreements if that overseas entity is not operational. And the tax authorities in China will be checking for this, especially if it's a high value that is being remitted. And then ultimately realize that there are Forex issues in China. So one thing you can consider is potentially putting your registered capital in as renminbi, which means that you can also then repatriate dividends in renminbi. Alternatively, you can open up renminbi accounts abroad, and for any service contracts that you are implementing to be able to repatriate profits, or even just generally service contracts where you're invoicing Chinese customers in China, do that in renminbi and have a renminbi account abroad. This allows you to control the currency exchange, but it allows the Chinese party to smoothen the process. They have a couple of steps less that they have to do in terms of the repatriation, in terms of the actual physical transfer overseas. Okay. So before I can talk about profit repatriation, I want to be able to explain the foundation of profit repatriation in general. So if you want to choose the most transparent method of repatriation, it would be through dividend. In order to be able to repatriate dividends from China to the shareholder, you first have to pay enterprise income tax in China. This is profits tax, okay? Now, in all of China, the profits tax is set at 25%. However, there are exceptions. If you are a small, medium-sized company with a net profitability of up to 1 million renminbi, your profits tax currently will be at 5%. If it's between 1 and 3 million renminbi, you'll be at 10%. Anything above 3 million renminbi will be at 25%. If you are located in specific zones, like for example, the Qianhai economic zone in Shenzhen, that whole zone has all companies registered in that zone have a profits tax liability of 15%. If you are a designated high-tech enterprise, your profits tax rate will also be at 15%. If you are in other types of sectors and industries, your profits tax rate might also be lowered. So generally it's 25%. As you are a startup in China, like I said, a designated SME, it's going to be between 5 or 10%, depending on your net profitability value, and then depending on where you're located or the type of business scope that you have. Now, before distributing after-tax profits through the method of dividends, foreign invested companies are required to make up any losses carried forward from previous years. Okay, this is a must. So that is step 1. You cannot repatriate dividends if you haven't made up for the losses. Losses can be carried forward for a period of 5 years. Okay. For the year 2020, if you do have an entity in China and it was running in 2020, if you made a loss in 2020, that will be carried forward for 6 years. But all other fiscal years are carried forward for 5 years. Okay, that was just a COVID preferential policy. In addition to that, so you've got to make up the losses. Once you've done that, you are required to allocate a certain rate of your after-tax profit into a reserve fund. Now, for foreign invested companies that have one foreign invested shareholder, it's just money that has to go into a reserve fund. For joint ventures, there are 3 funds. One is a reserve fund, an enterprise development fund, and a staff incentive and welfare fund. I'm going to explain what these funds are on the next slide. Okay, so for limited liability companies where you are a foreign invested company, you have one foreign investor as a shareholder, you are required to allocate 10% of your after-tax profit to the reserve fund. You cannot reduce this rate. And the cap of this fund is when the amount reaches 50% of your allocated registered capital. So if your registered capital was $100,000 US, once you've hit the equivalent of $50,000 US in renminbi, then you don't have to put any more funds into that reserve fund. Okay. And for these types of entities, there is no development fund or staff incentive and welfare fund. Now, you might be asking yourselves, why are there these reserve funds? The reason is in case of bankruptcy, that you have allocated funds into these reserves that are only to be utilized at the point of declaring bankruptcy. And at that point, those funds are utilized to pay off any of your liabilities. Now, for joint ventures, there's no minimal or maximum limit on the amount of allocated funds. This is going to be discussed in the joint venture contract, and the board of directors will decide on that allocation. I mean, ultimately, the shareholders, the multiple shareholders will decide on that allocation on their own initiative, and it will be part of their company bylaws, their articles of association. If anybody has any questions whatsoever, put it in the chat box, and then we'll get to them during the Q&A, okay? Another consideration that you have to make when you are repatriating funds is transfer pricing regulations, okay? The most critical thing I want people to realize is that transfer pricing documentation does not have to be submitted to anybody until one of these 4 items that I've listed here has befallen you within your Chinese entity. The most common item is interrelated party transactions which exceed 40 million renminbi within a fiscal year. So if in a calendar year, which is a fiscal year in China, you have sister party transactions, i.e. you are repatriating funds not only to the shareholder, but any other company within the group of companies amounting to 40 million renminbi, that will be a trigger for your tax officer to say, I want to see your local transfer pricing file to understand your transfer pricing regulations. Okay. Now, ultimately, again, within 6 months of incorporating your entity in China, not only should you be thinking about profit repatriation strategies, but whilst you're thinking of profit repatriation strategies, you should be thinking about your transfer pricing regulations and understanding what type of margin is going to be kept in China. All right, now we're going to touch on the methods of profit repatriation, okay? And the actual process that it takes to repatriate. Okay, and I've provided document lists. I have provided a lot of things that are generally required, but it's always a matter of talking with your tax officer and bank in terms of what is actually needed. So methods of profit repatriation. Now, when we are talking about profit repatriation, we have to look at the double taxation agreements between the shareholder or any sister related companies within the group and your Chinese entity. Now, for today's purposes, and because Douglas was asking about it in last week's roundtable about dividend rates and whatnot, I've used the United Kingdom as an example. This is when you look at the last column, which says the latest DTA rates, those are the current double taxation rates for dividend transfers, interests, royalties, and capital gains from China to the UK. Okay, so any overseas transfers related from China to the UK. Now, for those of you that are on here that don't have an entity in China, this won't apply to you. But I will be getting on to what it takes to do an outbound transfer. Okay, so these are the rates. Please look at the last column. So dividends is 5%, interests are 10%, royalties are at 6%, and capital gains is at 10%. So the first methodology to repatriate funds is the most transparent methodology, but it also means you've got the highest tax liability, which is by doing a dividend repatriation. Okay, and I'll use Woodburn as an example because I did a dividend repatriation in 2022, and let me tell you, it was quite a process. The whole thing from start to finish, meaning the application, the point of application with the tax bureau all the way through to the bank transfer, took 7 months. Yes, that does mean because you have to do all of your annual compliance procedures first. That means we could only start the application in August. We did the dividend transfer in 2023. All right. That was the entire application. That was the back and forth discussions. That was the additional documentation that had to be supplemented. Then original signatures, so back and forth of documents, etc. The whole process took 7 months. Now, when you are doing a dividend repatriation, you have to think about the business side of what it takes to repatriate. So I mentioned earlier that the after-tax profit can only be repatriated. I didn't mention this earlier, but I do want to highlight it here, is if one registered capital has all been injected. In our case, our registered capital has not all been injected. We were able to write a board resolution saying that although our registered capital has not been injected, we still have made enough profit that we would like to transfer it abroad. So I've written in theory here because I've gone through it myself just last year. It was not a requirement by our tax officer, nor by our bank. The next is that your prior year's losses have to have been made up. Okay, so we at Woodburn were in the clear. We had no losses. All the losses had been cleared away. We were good to go and repatriate our funds. We then had to set aside 10% of our profitability into a reserve fund. Now, how this works is that the auditor at the year end will allocate this 10% into a reserve fund. There is actually no cash flow. Okay, there is no actual fund that is set up or anything like that. It is just stating that in your audit report, you have made this reservation, if you will, of 10%, and you really need to make sure that that money is always available should you have to declare bankruptcy. But like I say, there's no special bank account, there's no special fund account where this money is transferred to. Okay, but it does have to be allocated in your audit report. Now, in terms of tax considerations when doing the transfer, I want to highlight that you calculate your net profitability, and then there is this withholding tax that is imposed on the dividends. Now, if we go back to the table here, you can see that the dividends is at 5%, all right, which means that there's a 5% withholding tax that is going to be imposed onto the Chinese entity, okay, for the transfer to the UK. Now, depending on, now I've just put here another example because a lot of people historically have used Hong Kong and Singapore as shareholders for Chinese entities. Those DTAs also state 5%. In fact, most DTAs now within the European Union, Hong Kong, Singapore, I was just thinking earlier, I don't know the US by heart, but I believe the US is also at 5%, but it could be at 10. I'm not 100%. Don't vouch for me. That's research that has to be done. But what I want to highlight here is my last part of the sentence, which says, in some instances, the tax bureau may request to see that the shareholding company has economic and commercial substance. the question ultimately is by the tax bureau, is your shareholding company a pure holding company? Or is your shareholder an actual operational entity that has transactions running through it, has headcount running through it, it has an active P&L, okay? And if they have doubts, they will ask to see your shareholder's P&L, okay? So I want people to be aware of this because you have to remember that the 5% is a preferential tax rate based on the double taxation agreement signed between the two jurisdictions. But in that double taxation agreement, it states that the shareholder has to have economic and commercial substance. If it does not have economic and commercial substance, then you will be obliged, go back to the table, to pay a 10% dividends tax rate. Okay? So just be aware of that. All right. Now, the actual process in terms of the outbound payment of this dividend value. So in China, you have to go to the tax bureau. You cannot go to the tax bureau until your annual audit and all the annual compliance procedures have been completed. That means the annual profits tax filing and the annual inspection. All right. Now, I don't know if many of you are aware of this, but in China, it is actually not required by law to do an annual audit. However, you're kind of sucked into the situation because when you do your annual profits tax filing, you have to tick a box which says that your annual audit has been done, and then you have to put data from your annual audit into that annual profits tax filing report. The same when you've got the annual inspection, which are statistical reports that are distributed amongst the top 7 different government bureaus. You also have to tick a button which says, have you done your annual audit report? And then you also have to put data in there from that report, okay? So although audits are not required by law, you are obliged to do it because of tax bureau and government bureau requirements to see that data inside. I also want to say that the bank is going to require to see all annual audits. So once you do your first dividend repatriation, they will require to see all of your annual audits from the start of incorporation. Okay, so be wary of that. The next thing that happens is you have to sign a board resolution from your, signed by the board of your Chinese company, which states that you want to distribute profits as dividends. Then you show with your annual audit, the compliance procedures, the board resolution to your tax officer, and you state, we want to make a dividend application. And most importantly, we want to apply for the double taxation benefits that are associated. Now, I'm saying we go to the tax bureau. It's not like that. In places like Shanghai, Beijing, and other big cities, even tier 2 cities, a lot of these tax applications are now done online. So there's an online system that you go through, you tick a series of buttons that you want to do a dividend application, and basically you fill in all of the data and you have to upload these documents within it, okay? Now, the difficulty that we had last year was predominantly because of the lockdown. There was just so many issues with gaining access to these government websites that continued all the way through the summer months and even up until September and October. We're hoping that for our clients that are doing dividend repatriations as well, for us this year, we won't have these issues because there won't be this lockdown. So we cross our fingers, but we do believe that's why the 7-month delay occurred, okay? If the online system is not working, my biggest recommendation is go meet with the tax officer face-to-face and say, what is going on? Show them your computer screen when you're there, showing that you can't upload documents or you're not going on to the next page, etc. They've got to help you. Do that in person. Don't waste your time doing it over the phone. Makes no sense, okay? Filing of the profits tax return is part of the annual compliance procedure. That's a document that you then have to upload as well. And then if the dividend transfer amount is over $50,000 US, you have to file another record filing application which is part of the online system that you have to complete as well. It's kind of like a self-declaration that the amount is over 50,000 USD. Like this, you don't have to go to the State Administration of Foreign Exchange, because once you do this record filing, they will receive that and then approve the application automatically. Once this is done, and once the tax bureau says you don't have to provide any further supporting documents, you can then go to the bank. I just want to highlight, though, that tax will be paid, meaning that the 5% withholding tax will now be paid, okay, upon approval from the tax officer. Once you have that tax receipt, together with all the other documents as well, you head over to the bank for the payment approval process, okay? Now, could there be cases where the tax officer says they need additional documents? Yes. Like I mentioned earlier, if they have doubts that the shareholder is a holding company, they might come back and say, please provide us supporting documents. We want to see the P&L of your shareholding company for XYZ number of years. So you've got to be prepared for this feedback, and you've got to be then prepared to also submit additional documentation. My recommendation always is have a conversation face-to-face with your tax officer, understand what documents they need, realize that dividend applications, your tax officer might have had no experience with this. So in the last 12 months, we have changed tax officers 4 times. I think it was tax officers 1 and 3 knew fully and clearly what was the process for dividend repatriation. 2 was clueless and always had to go to their superior, which wasted more time for us. And the 4th one, which is our last one, we did not do anything with them because the transfer had already been done. So I just want to highlight, you might have tax officers that are designated to you who don't even know how to do this themselves, okay? And then you're losing time because they have to go to their superiors to learn how the process actually works. It's ridiculous, I know, but it is a fact of life, and this is what happens on a day-to-day basis. So once the tax aspect is done, you head over to the bank, okay? When you are at the bank, you have to fill out an application form, which is issued by the bank. You then have to sign, again, a board resolution. So one of these board resolutions is for the tax bureau, one is for the bank. You have to show all audit reports. So whereas the tax officer only wants to see the audit reports for the years where you've been profitable, the bank, and don't ask me why, it makes no sense in my mind, will want to see the audit report since incorporation, if that is your first year of dividend repatriation. Then they will also want to see, in the previous one, I said we have to file the record filing with the tax bureau depending on the amount. They will want to see a copy of that filing. They will want to see proof that the registered capital has been paid and that the reserve funds have been allocated. They're going to find from the audit reports whether you have carried the losses forward. In our case, we didn't have to show proof of the registered capital because we didn't have any. Our registered capital hasn't been transferred. And reserve funds allocated, that was also shown in the audit report, but we had to sign a separate board resolution to highlight that. What was really interesting in our experience last year with the bank was that our relationship manager at ICBC did not know how to do the process at all. They were learning just as we were submitting documents. They always went up to their superior. We lost a lot of time in that communication. In addition to that, they constantly asked us for additional original chopped and signed documents. It was just like a constant repeat for about 3 months. It was pretty ridiculous. But you know what? If you don't do it, they're not going to process it. So you just have to do it, right? So like I said, for us last year, it took 7 months. Once the bank approved all of this, the payment was then made to our shareholder, and that was that. Like I said, in theory, dividend repatriation is the cleanest form of repatriation. However, you are paying the fullest amount of taxes, right? You're paying your profits tax, and you're paying also then the dividends tax. The idea behind profit repatriation strategies is to create agreements or services that are true and authentic that also help you to lower your tax liability within your Chinese structure. Okay. And I'll use, again, our company as an example, because I always think examples help you to visualize these actual types of transactions. So in terms of service fees, now, starting from here, if you are a company that is transacting with Chinese companies in China, direct from the UK, US, wherever globally in the world with China, this will be useful for you because this is the exact procedure that your Chinese customers have to go through in order to make these types of outbound transfers for service fees. Okay, so be aware of this is what you should be listening in on. So the first step is that you need to have an agreement in place that has economic substance, where you have the ability to show proof that these agreements are true. Okay, so between Woodburn Hong Kong, which is our shareholder, and Woodburn China, we have a marketing service agreement. We, for simplicity purposes, Hong Kong pays for a lot of our overseas marketing expenditure because we don't want to have to deal with the Chinese VAT. We just want smooth, quick payments to be made to our third-party suppliers abroad, and it's easy to do that out of Hong Kong. However, those marketing initiatives are actually marketing initiatives that are for our Chinese business, not for our Hong Kong business, not necessarily. And as a consequence, we have a marketing service agreement between Hong Kong and Shanghai, where Shanghai has to reimburse Hong Kong for all those marketing costs that it has paid on its behalf. Okay? This is really not complicated, right? What is interesting from this year, was not the case in previous years, is starting from this year, the bank has, not the tax bureau, the bank has required to see the original agreements between Hong Kong and our third-party providers, plus those invoices, to verify that our marketing service agreement is real. We also have another client based in Beijing who does direct goods sales. So sells goods from the UK to Chinese customers direct. Their Chinese entity does technical support services, installation of the machinery, and the sale of after sales repair goods. How do you say? You know, if a good has, if a piece of the equipment has broken, they do the repair of that equipment, etc. So they're more technically oriented. But in order for the company to run, China issues an invoice where they will earn a commission on every sale of a machinery that is happening. As of this year, the bank has required to see all of the original sale of machine contracts that are between the UK and China. Now, I want to highlight this because this has never happened to us prior to January 2023. That all of this additional documents and invoices have to now be supported and provided to the Chinese tax officers, which obviously means it's more work for everybody. Those that are sitting in the HQ and those that are sitting in China that are just trying to get these payments processed. Okay, which is why I mentioned earlier, it's all about being organized now. And if you're listening to this, you have to understand that documents have to be properly organized, and you need to have standard operating procedures that if China requires any documents whatsoever from the head office, that you can provide that and support that. Very simply, there is no negotiating this with the banks. Nothing. Okay? So it's not like you can go to the bank and say, oh, please, 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 why do we have to give this? We never had to give it before. Da, 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 da. It's not working. They're basically saying, if you don't give it to us, we can't make that payment for you. All right. Now, I've given you the example of the marketing service agreement. I've given you the example of my client in Beijing, which has the commission invoice agreement. There are other types of service agreements that you can create in terms of management service agreements, technical service agreements, but I just want to highlight that these agreements have to be true and authentic because the banks are asking for these supporting documents. And if you can't provide that additional support or those additional, the transfer will not be made. It will be blocked. Okay. The service fees that you are implementing, again, I want to highlight, think about transfer pricing model. Nobody is going to question your formula or how you're coming up with the payments. They might question it if it is completely, if the numbers are created that are completely out of thin air and are not based on market rate. So, you know, in terms of marketing service agreements, what we have done very simply is just that it's a payback. We haven't actually even done a transfer pricing model. We just want it to be a very simple payback plus additional miscellaneous costs for bank transfer fees. So, and for that, we are saying we don't need a transfer pricing model because Hong Kong is doing it on the behalf of China and China is just repaying it back to Hong Kong. It's not a formal transaction. But for those commission agreements, you have to think about transfer pricing. For technical service agreements, you have to think about transfer pricing, okay? Remember that all contracts should be in Chinese language. The banks and the tax bureaus will not look at anything else. So if you have created your agreements in English, you will have to get those translated purely for the purpose of submission to the tax bureaus and to the banks. And then last but not least, I just want to highlight here, in the double taxation agreements, there are going to be permanent establishment guidelines. Think about this, right? With the UK and China DTA, the guideline is 183 days for permanent establishment within a calendar year, within a fiscal year. So be aware of that also when you are creating these types of service agreements and structures. Now, when you are doing these types of transfers, you have to be aware of a couple of things in terms of the taxes. And again, this is where I don't want people to get cheated on by their Chinese counterparts. So the first thing I want people to be aware of is, depending on the type of service, you might be able to get exempted on the VAT or credited on the VAT. If you guys have not seen my previous roundtables on VAT, I have slides in there which highlight the types of industries and sectors, i.e. the types of invoices where you could get VAT exempted or credited. It's really not for everybody. It's definitely not for our business. We can't get VAT exemptions or credits, but depending on what industry and sector you're in, you might be able to. Then on that invoice, there is going to be VAT. Now, if that Chinese entity of yours is a general VAT taxpayer, you'll have a 6.8% VAT and surtax. If you are a small scale taxpayer, I've put here two rates, 1.5 and 3.5. 1.5 is currently under COVID regulations. 3.5 is under normal circumstances. Our belief is that starting from January 2024, if you're a small scale taxpayer, we will be going back up to the 3.5% VAT rate. Okay, but as of 2023, it's 1.5. By 2024, could be 3.5. Now, in addition to that, you have to think about the withholding tax rate, which may be applicable, again, depending on the type of service that is being issued, okay? Now, in relation to these three, let me go back a slide, and the three that I highlighted here, which was marketing services, management service fees, technical service fees, and commission invoices, there is no withholding tax rate. These are just general service fees, service contracts, okay? So there is no withholding tax rate. If, however, you fall under licensing fees, royalty fees, etc., then that might apply, okay? So again, when you are, and I'll explain the process of how to get all of this registered with the tax bureaus and banks, when you are discussing with the tax bureau about what taxes would be applicable on the agreement, yeah, you need to explain the context of the services that are being rendered to understand whether you can be VAT exempt or credited, whether there's going to be a withholding tax or not. The 6.8% VAT or 1.5%, 3.5% VAT will always be applicable. Okay. All right, so let's talk a little bit about the actual physical process. All right, so the first thing that you have to do is go with the contract and preferably with the invoice to the tax bureau. The tax bureau is going to do a complete review of your contract in detail on the Chinese version. Okay, they are going to come, it's going to be a back and forth discussion in terms of the wording of the contract. Now, what's interesting is that you might have hired lawyers to draft these contracts, but when it comes to the actual payment process, these tax bureaus and banks may require you to amend them. I want to highlight here that when you make those amendments, this is just for internal. It has nothing to do with your customer. I mean, the Chinese company has to do that internal amendment. It has nothing to do with the overseas entity and the formal contract that's been created. You have to make these amendments to make sure that the tax officer agrees with them to then approve that the tax liability can be paid. The same with the bank, it's just to make the bank happy. And for me, it's an internal issue. Chinese company to tax bureau, Chinese company to bank has nothing to do with the overseas company. Okay, so don't get now overwhelmed by having hired lawyers who've drafted these agreements that are bulletproof with exit clauses with your counterparts abroad. This is internal, okay? Just make them happy, okay? Now, this contract registration can take time. I am in a current contract. Oh, and I also want to highlight here, tax bureaus don't like to see open-ended contracts. So they like to see fixed term contracts with 1, 2, 3 years in them. And then it means that you always then will have to renew them, okay? Don't ask me why. I don't understand the logic, okay? It just is what it is. So you do your contract registration. There's going to be this back and forth discussion. You might have to make some little amendments to the Chinese version of the agreement in order to make the tax officer happy. They will then stamp off on it that the contract is approved, and you will have a tax number allocated to that contract. When you are having that back and forth discussion, as a part of it, you should be saying, we want to apply for the double taxation benefits if the withholding tax is applicable on that agreement between the two jurisdictions. The tax bureau will check, is the shareholder a holding company or is it an operational entity? You will then have to file the VAT. You may have to then get VAT exempted or credited. You will then, depending on the service agreement, have to pay the withholding tax rate. Okay. And if the amount of the invoice is over 50,000 USD, you will have to do a record filing with the tax bureau as well. Now, once the tax on that first invoice that has to be paid is paid, you then go to the bank with that tax receipt. Okay, and all the other additional documents. Now, if people ask me a time frame, it's very hard to give a time frame. It can take anywhere between 2 and 8 weeks to get a contract registration done. So not quick at all, okay? So you have to be aware of that bureaucracy that's involved. Now, once you go to the bank, you take the service contract, you take the invoice, you say that the taxes have been paid on it. Then the bank will come back and say, okay, you now have to provide additional supporting documents. So like in our case, we have had to provide original contracts and invoices that are between our Hong Kong company and our third-party providers that are based throughout the world that do marketing for us. And we've had to first translate them because they're not in Chinese, translate them, and then submit them to the tax office. So you've got to be aware that additional documents may have to be provided. Now, to give you other examples, prior to COVID, if you had a management service fee agreement The additional document that was be required is the entry and exit stamp of the managers that were traveling to China. Right? Management fees means that it's a service agreement where you have managers from abroad traveling to China, and their mandate rates or their expenses should be settled by the Chinese company. Okay. And it could be like a pro rata of their monthly salary, however you want to formulate that. It could be a mandate rate, hourly rate, whatever you want to do. And so in those situations, they want to verify that these managers actually came to China. Then COVID happened, borders were shut down, and people were actually working for the Chinese entity, but then from abroad. And at that point, it was very difficult to prove. So I have to say that 2020, 2021, and 2022, the tax bureaus and banks were not actually asking for any additional proof. It has really just picked up from January 2023, I guess, since the borders have opened, ultimately. But it's shocking, the difference, literally from December until January, how it has changed. Okay, so that is service fees, right? And then you've got royalty fees or licensing fees that you have to take into account. I'm talking about royalty fees now. You've got technology transfer agreements, trademark licensing agreements, etc. So if you've got a royalty fee, think about, again, transfer pricing. The contracts have to be in Chinese. I also want to highlight from this slide that the easiest form of repatriation is trademark, patent, licensing agreements. Why? Because whoever is abroad registered the Chinese trademark or the Chinese patent, they have that ownership, and the Chinese entity has to pay a licensing fee to use that. Very straightforward. We recommend to do transfer pricing models just to make sure you don't come up with an absurd percentage rate that needs to be paid back. It needs to be based on market rate. What, the tax bureau is going to be looking at your specific industry, your specific sector, and is going to be saying, compared to other companies, why is your rate, I don't know, 2 times higher than the others? So you have to make sure and think about it based on market level within your industry and within your sector. Again, contracts have to be in Chinese. Now, tax considerations. If you look at the DTA slide, if it is a royalty fee, you're looking at a 6% withholding tax rate. If it is a licensing fee, you're looking at a 10% withholding tax rate. Okay, so it depends on the type of agreement that's being put in place. In addition to that, there is going to be a 6.8% VAT if that Chinese entity is a general VAT taxpayer, or a 3.5% slash 1.5%, I should have put here, slash 1.5% VAT if you're a small scale taxpayer. Okay, so again, think about the tax considerations that are going to be imposed. Then the outbound payment process is exactly like I mentioned previously. You have to do the contract registration with the tax bureau. You've got to apply for the DTA benefits, file for the withholding tax rate and the VAT. If the amount is over 50,000 USD, you'll also have to do a record filing with the tax bureau. Taxes will be paid, and then you can go to the bank. Okay. Now, I just want to highlight that here I've highlighted the documents that have to be submitted to the tax bureau for the contract registration process. I wanted to put it somewhere. I wasn't sure where to put it, so I've just put it here within the presentation. So obviously, there's an application form that the tax bureau requires you to complete. Contract. You have to also submit the Chinese company business license. You have to provide the incorporation certificate of the shareholding company or sister company where this will be transferred to. If the fee is paid as a commission, you have to provide your calculation for that commission. You may have to provide the latest audit reports. If it's a trademark patent licensing transfer, then you have to provide the certificate of registration in China for the trademark or the patent as well. Okay. That's the general document list. But like I said, they can come back and say, we want more. We want more documents to prove that this is real and authentic. Okay. And this is why a lot of people don't take me seriously on this. It's really important to have direct and open communication with your tax officer and your bank. I want you all to be aware of that. Yes, the tax bureau's goal is to make money off of you by increasing your tax liability. But if you don't have that open communication, how do you know how to negotiate? How do you know how to bring it to the next level? If you have to have that open dialogue. Okay, so don't hide things, don't be sneaky with them, just be an open plate. And in order to be an open plate, you can't provide them with fake stuff. Okay, it has to all be real and authentic. Now, all of this in terms of profit repatriation strategies leads me to guiding you with the idea of what are suspicious signs for tax evasion by the tax authorities. Meaning, what are things that could be in your Chinese business that would cause them to say, I want to do a tax audit on you. I think you have faked a couple of things. The first one is significant amounts or numerous different types of related party transactions. If they are seeing that you are doing, I don't know, every single month, more than 2 transfers abroad to the shareholder or to sister companies within the group, they will be suspicious. In addition to that, if you've got long-term losses of low profitability or fluctuating patterns of profit and loss, they will become suspicious. You have a leeway within your startup phase to be at a loss. But if that continues, right, then they will be suspicious, which is why I say, try to develop these repatriation strategies within 6 months of having been incorporated so that those contracts are already registered, that the tax bureau can't say anything to you once you start implementing it. Okay? Don't do things suddenly when money suddenly appears in your bank account. That just raises suspicion. Plan, right? It's all about tax planning and being aware when to do the transfers. Now, the golden tax system, if you're not aware of it, which basically means that the tax bureaus do have internal market research analyses of industries and sectors within China. And if you are below average in profitability compared to your competitors, or profits are not matching the company's functions compared to your competitors, that will be a sign of suspicion. In addition, if your overseas transfers are predominantly to tax havens, Hong Kong is considered a tax haven. Guernsey, Isle of Man, British Virgin Islands, Seychelles, Mauritius, all of these places are tax havens, right? And if you have a lot of transactions that are going out to these tax havens, that is a sign of suspicion, right? Predominantly because most entities incorporated in tax havens are holding companies. So they don't have the economic and commercial substance. If you hit certain thresholds, or if the tax bureau requires you to submit transfer pricing documentation and that documentation is not ready or it's incomplete, then again, that's a sign of suspicion that you've never actually done your transfer pricing business model. And then obviously, if there are violations of the arm's length principle, meaning that you have manipulated the pricing between both parties, that's also a sign of suspicion. Okay. Now, a couple of tips to get your strategies set up in China. It's please have it in the back of your mind, create true authentic agreements. Think about internally within your structure, how could you repatriate profits? What type of modes are realistic where you can then provide supporting documents? I am sure that for everybody, trademark licensing agreements would be number one. Okay. Be smart and choose your battles. Okay. Whether it's with the tax bureau, whether it's with the bank. Don't argue about every single agreement. Don't argue when they say you have to provide supporting documents. This does not help your case, okay? Currently, in the last 4 months of operating, what we have seen is you just simply don't submit the additional documents they are requesting, they will not allow you to do the bank transfer. Full stop. So don't argue too much, right? You don't want to have a falling out with your tax officer over this. The third is conduct the contract registration as soon as you can, i.e. in the moments when you're not in a rush to get it implemented, which is probably when you're most not likely to do this because you have other priorities. This is why we always remind our clients, usually in the 6-month mind frame, hey guys, do we want to develop profit repatriation strategies or not? The reason why I say this is because it takes time. Like I said, it can take anywhere from 2 to 6 weeks to get them registered. All right. And once you've got that contract registration number stamped by the tax bureau, once that first invoice is raised, there's no more that needs to be done, unless they ask for supporting documentation. But it's unlikely that they're going to do that at that point. Then you've got to think about applying at that time to the tax authority for the tax assessment. So at the point where you're registering the contract is when you should be having that open discussion. When we raise these invoices, what type of tax liability are we going to have? Okay, we know there's VAT, but could we get an exemption? Could we get a credit? How does that work? Is there withholding tax applicable? Okay, and make sure you mention to them, you need to be proactive with this. You need to mention to them about the double taxation agreement. Okay. Now, to understand document requirements at the tax bureau or the bank, the best is to have a face-to-face with them to say, we want to do X, Y, and Z. What do you need from us? This conversation will go back and forth, but to initiate the conversation, it is always better to have it with the tax bureau face-to-face or over a WeChat call to say, this is our plan. Can you please guide us? What is the document requirements? It's never going to be perfect because they will always ask for more later on, but it's a great starting point to have that discussion. Okay, and don't be scared to have that discussion. Now, I'm going to reiterate what I said earlier in today's presentation, which is, when do you actually plan to be profitable in China? If you plan to be profitable from day one, then you need to be thinking about this straight away. But if you are thinking that your Chinese entity is going to be only a cost center, then this doesn't apply to you at all. Right? Because you're not planning on having any revenue. So I encourage you all, do your tax planning to understand when you actually intend to be profitable. As I mentioned in last week's roundtable, in terms of how to calculate your registered capital, it is really important to understand what are your cash flow needs and whether any of that cash is going to go out to pay for profits tax, VAT, etc. Right? So do that tax planning. If there's anything I want people to take away from today, it is make sure you think about your tax planning. When are you going to be profitable? At what point should these profit repatriations strategies be implemented? Because of the bureaucracy that is involved, plan ahead of time so that you're not rushing it. Easier said than done, I know. That's the end of today's presentation, guys. I would love to hear what your biggest takeaway from today was. And again, if you've got any questions, please insert them into the chat box. We are going to go ahead and start on any Q&A. So if you are struggling to create profit repatriation strategies, then just put them in. Are there any questions? Nothing has popped in so far. Nope. If people are taking their time to type, don't worry. I'm not leaving anytime soon. Rob's question is, how about realizing the revenue outside of China in the first place? Of course you can realize the revenue outside of China. The beauty of having a Chinese entity is the fact that you now have a second option. You can realize revenue in China, and you can continue to do what you've done before which is realize your revenue outside of China. By realizing your revenue outside of China, there's going to be no impact on your Chinese entity unless your Chinese entity is going to, like my client in Beijing, issue invoices for commissions, right? And that's what started the bombshell of then providing the contracts of the revenue that was realized outside of China, the invoices that were issued direct from UK to China, etc. But Rob, the beauty of having a Chinese entity is that you can structure your business any way you like. You don't have to realize your revenue in China. You don't have to realize all of your revenue in China. You can obviously still maintain a certain level of revenue outside of China, which means that you have the ability to negotiate with your clients saying, we keep the status quo, it's going to be direct transactions, or hey, I don't know if you guys know, we have a Chinese entity. Would you like us to invoice you from our Chinese entity? Totally up to you. Oh, Rob, good. I'm glad that's your plan. Just think carefully about, I just want to give you this one tip. If that is your plan, that the revenue is realized outside of China, if your Chinese entity is going to be then a cost center and you are going to have headcount, how are you going to fund that operation? Because last week's webinar was about using registered capital. At some point, service invoices have to be created. Now, this is a different discussion because right now in this presentation, we're talking about getting money out of China. This would be then you needing to bring money into China once the registered capital is used up. So think about that, okay, aspect. All right, guys, there's nothing else that has popped in. If people are still typing, go ahead, keep typing away. I'm not going anywhere right now. Just to finish off, once the recording is uploaded onto YouTube, I'll be sending out an email to everybody in the Thrive in China community with the link to the recording and a link to our calendar. So if you want to set up a call with us to discuss any pain points that you might be having, whether it's registered capital related, company or corporation, profit repatriation strategies, then you can do so. We'll see if we can help you. If you have colleagues, friends who want to join the roundtable, please do give them a link. The more the merrier, having people come in. And just a reminder, I know that in China, it's public holiday Monday, Tuesday, Wednesday, but in the rest of the world, Wednesday is not a public holiday. So we are going to have a discussion about how to choose the correct route to enter the Chinese market, i.e. what business models are actually available to you, all the way from distribution to cross-border e-commerce, procurement, service-related type business models. So stay tuned for that. And I want to thank everybody for joining me today. Apologies for the display. Wasn't quite what I intended, but something's up with my PPT at the moment. Rob, your question, can we get a copy of the presentation? I'm not distributing any of my presentations. I've had competitors use my content, and I don't do that anymore. So you have the recording, and you can always look at the recording on YouTube. So you will always have access to that. If you stay within the community, you can always have the link and watch it as many times as you like. But in terms of the actual PPT, I'm not distributing that anymore. All right, everybody. I've certainly run over. I apologize, but these types of topics do require a lot of explanation. And at least I hope I was clear on that as well. All right, thank you all. And I look forward to seeing you again next week. Take care and happy labor holidays to all. Take care and goodbye.